I'm going to break down trading interest rates into 2 simple steps that'll prepare you to profit from any rate decisions in the future. What's going on, guys? My name is Josh Paveo. I'm a full-time day trader, market analyst, and I run a private traders community called Wall Street Grunts. So when you're trading Forex, you're just trading 2 currencies against each other. Let's take a popular pair like GBP, JPY, GJ, Pound Yen, whatever people want to call it. You're trading the Great British Pound versus the Japanese Yen. Now, even though a central bank really isn't the only factor when you're determining the strength or weakness of a currency, that's going to be the focus of today's video because we're going to talk about interest rates. Now, interest rates are the #1 tool that central banks will use to control the currency. So because of a central bank's dependability on interest rates, it has a very large impact on the Forex market. So like I said before, I'm going to break this down into 2 categories, which is exactly how I plan all of our rate decision trades with Wall Street Grunts. And then to make things a little more concrete, we'll go to the charts. We're going to go over a Bank of England interest rate decision, and we'll talk about how you could have caught anywhere from 500 to 700 pips just off of one rate decision. So let's get right into it. The first thing you want to understand is what I call the baseline, which is basically just asking, what are the markets expecting? What are the market's expectations? When you're trading Forex, it's all about expectations. And we also want to know what happens when those expectations are broken, which is going to be number 2. But for right now, how do I identify the baseline? How do I understand what the market expectations are? So when I'm trying to establish a baseline, I basically like to ask myself a couple of the following questions. And the first question is, what was said at the last central bank meeting? During a central bank's meeting, they'll normally lay things out, like their outlook on the economy, and they'll also issue something called forward guidance, which is basically just like their plan on what they're trying to do with future rates. Basically, a real world example would be like, hey, if we see unemployment get better, we're gonna do a 50 basis point, also known as a 0.5% rate hike. So they'll say something like, if our employment gets better, we're gonna do a 50 basis point in September, we're gonna do a 50 basis point for the next 2 or 3 meetings, something like that. So you're trying to determine what the central bank's outlook was in the economy and what their plans were at that time. So then the next question I like to ask myself is, what's happened since the last central bank meeting, right? So the first central bank meeting, we got our outlook. What did the central bank say? And what's happened since then with the economic data? Is inflation getting out of control? Did employment see a surprise drop to the downside? What you want to do is you start paying attention to pieces of economic data points. Most times in between those 2 meetings, you're going to have a lot of central bank speakers come out and make comments. They'll say things like, hey, I didn't really like the inflation. We might have to raise rates. They're going to start hinting towards things before the markets actually get to that decision. And that's what helps us understand the baseline. And the second piece of the puzzle is what I call scenario building. Now I want to build out scenarios for 3 different outcomes. So the first scenario would be the central bank comes out and gives the markets exactly what they're already expecting. The second scenario would be the central bank comes out and they surprise the markets with a higher than expected interest rate. And then the third is going to be the opposite, if the central bank comes out and they give a lower than expected interest rate. So we have, as expected, a surprise to the upside, and then we have a surprise to the downside, and I want to plan for each individual trade. All of this is planned going into every rate decision that we do. Now, in theory, this can sound way more complicated than it really is, but let's go over a Bank of England rate decision that happened, and I want to cover how you could have actually, for one, how you could have formed your bias, how you could have planned your trades, and how you could have capitalized on anywhere from 1 to 700 pips, depending on how long you want to hold these trades.
How can I breathe? Smoke in the air, pure gasoline. I see the news, see what you read.
So let's start with this headline that came out while the markets were closed. The date was Friday, October 9th. I covered this exact scenario in the course, way more in depth, so I know the date very, very well. Brace for interest rates, warns Bank of England rate setter. So this is what you would consider a hint. So let's take a look at GJ at this exact same time, Friday, October 9th, and see what happened to GJ. So this area right here that I have circled on GJ is that exact same date. This is Friday, October 9th, when the markets actually started to open back up, right? Because over the weekend, the markets are closed, and we opened back up here and went very bullish. So if I were to measure this real quick, just to give you an idea on what GJ did, we went up a good 600 pips, 700 if we were to count it from the lows of the bottom here, 900 pips actually, right? So if we were to back test or go look at what GJ's been doing, you can see here, we couldn't break this area at 152,500 for the longest time, right? So you can see the constant rejections that we were getting. Every time we would hit it, we would retest, we would sell off again. We would come to a demand area down here, and then we would sell off once again that we came here. It wasn't until October 9th that we ended up getting enough bullish momentum, and given the rate hike hints, that we ended up getting this bullish run. Now, this is a perfect example of pricing in the markets, because now we get this headline, right, telling us that we should brace for interest rate hikes, but we never actually got an interest rate hike. So you can see GJ, we went very bullish, but we never actually had the rate rise. Nothing's happened yet. So now the market's going to kind of sit on the sideline and wait for the rate decision, which was November 4th, and see what happens then. So here's our baseline. The market's got the hint, and now they start pricing in for a 25 basis point rate hike. After that headline came out, central bank speakers started coming out and pushing against the markets buying the pound so much. They were saying things like they believe the markets are overbought. They think the markets and investors are over anticipating what the Bank of England is going to do. So if you start looking at GJ again, we can see that after we had that run, once the central bank speakers start talking a little bit, we get into this kind of like corrective bearish market structure where you can see that even the buyers and sellers strength kind of shift after breaking below here. You can see much more stronger bearish price action versus the buyer's price action coming in here. So now it's November 4th and the rate decision comes. The Bank of England surprises markets by holding rates at record lows. They pushed against any rate hike and kept the rates at 0.1%. So this was November 4th, 2021. You can take a wild guess where that decision was if I zoom out a little bit on GJ, right? Now I know this doesn't look like much because I'm on the 4-hour time frame, but these are hundreds of pips. This right here is November 4th. This is that decision right here. And immediately, without even hesitating, the markets dropped a good 250 pips. Ultimately, if I zoom out a little more, throughout the next month, we end up recovering. This is GJ, right? This is where we were at the lows. This is when we got the pricing in of the rate hikes. And then this is the buys that we get to capitalize on. We ended up getting that corrective bearish market structure here as the Bank of England started pushing against rate hikes. And then once we get the decision, the markets decided to sell off. We literally came all the way back down to 149 on GJ until we ended up finally getting our rate hikes in December when the Bank of England decided to raise rates. And then we recovered that entire move. So it's interesting. In October, we had a hint of rate hikes. In November, they had a confirmation of no rate hikes. And then in December, they had a confirmation of rate hikes. So if you look at December, we literally did the exact same move all over again, except this time you could have been more prepared, getting something at the lows here, catching the entire 700-800 pip move. I think I caught like 450. So if you look at the monthly, it's even more interesting now when you look at these three candles. Not that I trade the monthly time frame, but it's still interesting to see how now you have a better understanding. So this was October. You know exactly why October's candle went bullish. You know exactly why November's candle completely retraced that entire move. And now you know why December ended up going bullish again. And now all we did was get a little bit of a pullback and now continuations to the upside. Now you have your bias, right? Based off of these rate decisions that you're getting, it helps you create and formulate your bias. I'm looking for buys if this happens. I'm looking for sells if this happens. So it all comes down to understanding the baseline and then creating a scenario for both sides of the interest rate decision. With that being said, most times if the markets give you exactly what's expected, I tend to just leave it alone and I try not to trade it. Your best opportunities are going to come when you get a surprise to the markets. It doesn't matter if it's a surprise to the downside or if it's a surprise to the upside. Either one of those are going to give you a lot of volatility in one direction or the other. All you need to do is plan for that direction and understand what pair or what currency pair you want to trade ahead of time. Each one of these rate hikes were all surprises to the markets. The Bank of England ended up surprising the markets 2 to 3 times at the end of the year last year, so much so that there were a lot of headlines coming out talking about them losing credibility. I cover all those events in a lot more detail in the Operation Wall Street Forex course, but that would make this video way too long. Now, all I can do is hope that there was at least 1 or 2 nuggets in here that helps you become a better trader and be more comfortable trading rate decisions. I'll see you guys in the next video.